Hello, it's Dr. Fenor again. You know, I have many titles to me, but this time I'm putting up the title as tax accountant or accounting professor. And today, I want to speak about just tax deferred plans and retirement plans in general, because I know it's a very difficult topic to really understand. Today, I'm just going to speak about the difference between an IRA and an annuity. I know you'll have different views on what an IRA and an annuity is because all your different experiences that have been had. But an IRA, which is an individual retirement account. Again, an IRA is an individual retirement account. And annuities, they both provide the opportunity to grow money on a tax-deferred basis. Right? We're trying to defer those taxes to a later time. But there are essentially differences between the two. An IRA can be thought about as individual type savings accounts with tax benefits. You can either open up an IRA by yourself, or you can have another planner, another financial planner, or someone else within the financial field also create one for you. And if you have a spouse, you'll have to open up separate accounts. So you can't both have the same accounts unless you open a spousal IRA. An important distinction to make is that an IRA is not an investment itself. It's an account where you keep all the investments. So these type of investments may be stocks, they may be bonds, they may be mutual funds. What happens is you get to choose the investments in the account and change the investments if you wish at any time. Your return depends upon the performance of all the investments within the IRA. So for me, I like to diversify my investments. I may have some stock, I may have some bonds, I may have some that are mutual funds. IRAs are regulated by the IRS, and the IRS usually sets these requirements and limits on how much in contributions you can actually make, and how much in distributions you can actually take. And you may be taxed upon those distributions, and whether that be because of your age or the timing in which you do it. For example, in 2019, the maximum you could contribute to a traditional or Roth IRA is smaller of $6,000. It's $7,000 if you're 50 years old or older. Traditional IRAs regulations allow you to take early withdrawals under certain circumstances. And if you have a Roth, you can withdraw contributions at any time. But you'll have to pay a penalty because of it. Annuities are essentially insurance products. They provide a source of monthly, quarterly, annual, or lump sum income during retirement. An annuity makes a periodic payment in a specific amount of time. For example, the death of a person who receives the payments. Unlike an IRA, which typically have only one owner, an annuity can be jointly owned. And annuities don't have any contribution or income restrictions that IRAs have, which is why you should look at potentially having an annuity. You can fund an annuity all at once, also called a premium, or you can just pay over time. With an immediate annuity, also called an income annuity, fixed payments begin as soon as the investment is made. If you wish to invest in a deferred annuity, the principal you invest grows for a specific amount of time until you start taking withdrawals. Normally, people take withdrawals within retirement. Annuities typically have higher expenses than IRAs, and if you take early withdrawals, you'll typically have a penalty. So, just to give you a little bit of more insight, upon these IRAs. Some people confuse IRAs for a type of investment. IRAs are just vehicles that allow you to hold the investments with various tax advantages. Again, people commonly just invest in stocks, bonds, and mutual funds inside of the IRAs. Other options are sometimes available, but it can get very complicated. The IRS places some income limits on tax benefits as well as some contribution benefits. Just to reiterate in summary, annuities are contracts with insurance companies. They often come with some level of guarantee, but typically at a much higher fee because they're guaranteeing more. A fixed annuity will pay out a predetermined amount based on the contract. A variable annuity allows you to invest into, of course, the stocks, the bonds, the mutual funds, etc. But annuities don't have income or contribution limits. But both provide tax advantages and deferred growth. And that's some of what you should understand about annuities and IRAs.